Which market is a better hedge when a geopolitical conflict started? I know many will say that it must be crude oil, but over the past two major conflicts, we could see that crude oil did not gain any momentum. In fact, it came off. And during the start of the Russia-Ukraine war in 2022, the crude oil initially went up very briefly, and then it came all the way down for many months. And at the start of the Middle East conflicts in 2023, the crude oil immediately came off. So which market have reacted positively to all these tensions so far and will continue to remain this way with future tensions? My name is Con Hao. My work in this channel, as always, is to study behavior science and finance, discover correlation between different markets, and uncover potential opportunities. And before we get into the subject, please do take some time to read into the disclaimer. So exactly which market is a better hedge when a geopolitical conflict started? It is interest rate. But why it reacted well with geopolitical tension and how to engage them as a hedge other than using interest rate as a saving. And what we're seeing here is the Fed fund rate. It can be also referred as the interest rate or the yield. And we can see very clearly that at the start of the Russia-Ukraine war on 24th February 2022, the next month, the Fed raised the interest rate. It was almost immediately. And the start of the Middle East conflict last year in October 2023, the interest rate so far has maintained. And we just heard that Jerome Powell said that the inflation remained high and unlikely we're going to see interest rate cut anytime soon. And let's also look at the 2 years yield. And 2 years yield also refer to interest rate, or you can refer them as a 2 years fixed deposit saving rate as well. They are different, but they're similar. They move in tandem together. And we could see it's much more sensitive compared to the Fed fund rate, that during the Russia-Ukraine war, immediately the 2 years interest rate or the yield went up. Then during the Middle East conflicts, it came off a little bit, but it's still within the upper band. And we can see very clearly that at the start of, maybe I should switch to the weekly chart. At the start of the last week of the Middle East conflict, it kind of expanded, this conflict expanded. We saw that immediately the 2 years yield start to move up. And let's discuss about the fundamental reason followed by its technical why, starting from 2022, with any start of a geopolitical conflicts, yield or interest rate should continue to trend higher. And let's start off with the fundamental reason. Now, because of the trade war started in 2018 between the US and China, the free trading environment that the whole world used to enjoy for decades has been disconnected. And this caused the supply chain to be highly inefficient until today, thereby increasing the cost to many businesses. And of course, that increase will pass down to the end consumer. Therefore, today we are all experiencing a higher inflation. And with a high inflation, yield and interest rate will rise. And let's look at the technical reason. And for that, I'm going to move into a yearly chart. And this is the yearly chart that we can see. We saw that over the last 40 years, the interest rate has been coming down. But what I saw that in 2022, it finally broke above this downtrend line. It also signaled that in decades to come or long term to come, the interest rate inflation to trend up. And that's why over the last 40 years, it makes a lot of sense to borrow money to buy assets like property stocks because they are moving up. And it's wise to get into some borrowings. But moving forward with a higher inflation that will produce a higher interest rate, I will reduce my debt significantly. And that's something that we can do is to hedge into the interest rate. But how to do that exactly is that how to engage them as a hedge. And what we're seeing here is these are the 2 years yield, 5, 10, and 30 years yield or interest rate. We can't really trade them or hedge them because these are the cash market. And what I do is that, again, I will reduce much more of my borrowings, get into business if I could, produce more of my currency, whatever country you're from. And then how to hedge inflation that I will definitely deploy, say, for example, the 2 years yield futures. This is that you can trade and buy into it directly. Even you have a short-term view for a few days or few weeks, because the interest rates are always volatile. So this is what we and how we can engage a higher inflation or interest rate to come. And I believe that interest rate over the long term will continue to trend higher because we are just at the beginning of more geopolitical tensions since the start of the trade war in 2018. And for that, it will produce more inflation, or at least inflation to stay at the current level. Therefore, inflation will remain elevated. Stay tuned for my coming tutorial and remember to subscribe to my channel. The market are always telling us on their next move. Join us in our weekly case study and discussion. Click on my profile icon or description below to find out more. Feel free to leave any comments below. I love to exchange ideas with you. Really happy that you stay through this tutorial. You have many great trading weeks ahead.